Welcome to Financial News Daily, your trusted source for the latest global financial updates. Today is May 29th, 2026. This is a special edition. We look back exactly 10 years, comparing May 2016 to May 2026 to answer the question every investor is asking right now. Gold, real estate, stocks, or bonds? Where should your money be? Let's break it down. Gold, the decade's undisputed champion. In May 2016, gold was trading at around $1,250 per ounce, quiet, range-bound, and largely ignored by mainstream investors. Fast forward to May 28, 2026, gold is trading at $4,456 per ounce. That is a gain of over 250% in just 10 years. To put this in perspective, if you had invested $10,000 in gold back in 2016, your investment would be worth over $35,000 today. What drove this extraordinary decade? First, the COVID pandemic of 2020 shattered confidence in paper assets and triggered a massive flight to safety. Second, the Russia-Ukraine war in 2022, followed by the Iran conflict of 2026, created a permanent geopolitical risk premium now embedded in every gold price. Third, gold hit its all-time high of $5,590 per ounce in January 2026, driven by central bank buying from China, India, and Eastern Europe, nations reducing dependence on the US dollar. Gold has since corrected to $4,456 today as optimism grows around a possible US-Iran peace deal and the potential reopening of the Strait of Hormuz. Analysts at J.P. Morgan still project gold targeting $6,000 to $6,300 per ounce by end of 2026. The 10-year verdict on gold is clear. It was the single best-performing major asset class of the decade. Stocks, strong but uneven. In May 2016, the S&P 500 was trading around 2,100 points. Today, in May 2026, the S&P 500 has delivered approximately 250% total return over the past decade, averaging 9% per year. On the surface, this looks impressive, but the story beneath the headline is one of extreme divergence. Winners of the decade: semiconductors, AI technology, defense contractors, and energy producers have delivered exceptional returns, with margins expanding sharply in 2026. Losers of the decade: consumer discretionary, traditional retail, and office REITs have struggled badly, crushed by inflation, high rates, and structural shifts in how people work and spend. The critical difference from 2016? In 2016, you could buy almost anything in the S&P 500 and do well. In 2026, stock picking matters enormously. 78% of S&P 500 companies are beating earnings estimates, but performance is far from even. The message for investors: broad index investing still works, but sector selection is now more important than ever. Real estate from boom to pressure. In May 2016, global real estate was in a sweet spot. Low interest rates, strong demand, and rising prices across the US, Europe, and Asia. The decade since has been a tale of two halves. From 2016 to 2022, real estate delivered outstanding returns. Low mortgage rates made property accessible and attractive, but from 2022 onward, aggressive rate hikes by the Federal Reserve and central banks worldwide fundamentally changed the math. Today, in May 2026, with the Fed holding rates at 3.5 to 3.75% and the Iran war keeping inflation stubbornly above 3%, residential real estate demand is softening in most major markets. High borrowing costs have priced out millions of potential buyers in the US, Europe, Australia, and Asia. Commercial real estate faces deeper challenges. Office vacancy rates remain at record highs as hybrid work becomes the permanent norm. However, bright spots still exist. Industrial properties, data centers, and logistics hubs near AI campuses have delivered exceptional returns. And in emerging markets, Vietnam, India, and Indonesia, urbanization continues to support strong long-term demand. The 10-year verdict: real estate rewarded those who bought between 2016 and 2021. New buyers entering now face significant headwinds. Bonds, the decade's biggest disappointment. In May 2016, bonds were considered a safe and reliable income source. With yields near historical lows, they offered stability, if not excitement. The decade that followed was brutal for bond investors. Rising inflation from 2021 onward eroded the real value of fixed income. The Fed's aggressive rate hikes caused bond prices to collapse, delivering some of the worst annual returns for bonds in modern financial history. Today, in May 2026, with the Fed on hold and inflation still above target, the bond market remains challenged. Short-term Treasury bills now offer yields around 3.5 to 3.75%, which sounds attractive, but barely keeps pace with inflation. The one silver lining: if the Iran ceasefire holds, oil prices fall, and the Fed eventually cuts rates, long-dated bonds could deliver strong price appreciation for investors who position now. The 10-year verdict on bonds, a decade to forget for most investors. But with rates at cycle highs, selective bond exposure may make sense looking ahead. So, where does this leave us as investors in May 2026? Here is the 10-year scorecard. Gold, up over 250%, the clear winner of the decade, still supported by geopolitics, central bank buying, and inflation fears. Stocks up 250% on the index, but massive divergence between sectors. AI, semiconductors, and defense lead. Quality selection is essential. Real estate, strong from 2016 to 2022, but high rates have created headwinds. Selective opportunities remain in emerging markets and industrial property. Bonds, the decade's underperformer. But with rates near cycle highs, a strategic allocation may now make sense as an insurance policy. The bottom line for 2026, diversification across all four asset classes remains the wisest strategy. But if you are watching one indicator above all others right now, watch the Strait of Hormuz. A peace deal between the U.S. and Iran could simultaneously push gold lower, boost stocks, revive real estate sentiment, and open the door for the first Fed rate cut of the year. The world is watching, and so are we. Here at Financial News Daily, thank you for watching today's special report. If this analysis helped you make a more informed investment decision, please give us a like and hit the follow button so you never miss our daily market briefing. Your financial future matters. Stay informed, stay ahead. See you tomorrow, right here on Financial News Daily.